few minutes from the close of trading here in the U.S., live from Bloomberg's world headquarters in New York, I'm Scarlet.
I'm Joe Weisenthal.
And I'm Oliver Rennick. The S&P 500 flirting with a ninth straight decline, with the dollar lower today on anxiety over the election.
But the question is, what'd you miss?
Today's takeaway from the jobs report: millions of Americans have gone back to work since the last recession. Now they're finally getting some decent pay raises as well. We'll break it all down with JP Morgan's chief U.S. economist, Michael Feroli, in just moments. And while investors took comfort in the labor picture, anxiety about the outcome of the presidential vote has weighed on stocks, overshadowing even a Fed meeting earlier this week. We'll take a look at how currencies are poised to react to the election. And as political risks continue to rattle markets, more and more managers are hedging their risks to either candidate. We'll speak with one Volatility fund manager who says that a Trump victory could keep the VIX at 30.
All right, but for now, let's get some more on the market action heading into the close. Abigail Doolittle is standing by. Abigail?
Well, it's turned into another bit of a volatile day here for the NASDAQ, the S&P 500, and the Dow, the three major averages, Oliver. And not so much from a standpoint of percentage change, but from the fact that we've been flipping from green to red, and right here into the close, we've had both the S&P 500 and the NASDAQ turn slightly red. Now, on the week, it's been very volatile. We have the three major averages all on pace to finish lower on the week by more than 1% for the second weekly decline in a row, for the worst decline since September 9th. Not surprisingly, then, the VIX, or the fear gauge, is also higher on the week. And in fact, if the VIX closes above about 22, it will suggest that the VIX is going to be putting in a record 9 days higher. So really a tell on the idea, and right now on pace for that record 9th day higher, a tell on the idea that investors are on edge, as you mentioned, ahead of election. Confirming all of this from across asset class, crude oil. Crude is down on the week, in fact, on pace for its worst week since January, as a bit of a signal around the economy and growth. And when we go into the Bloomberg and we take a look at #BTV 4793, the S&P 500 put in another risk off, or suggestion that we could see some risk off ahead signal today, and that is the fact that the index tested its 200-day moving average, touched right down onto that moving average. Above it is bullish, below it is bearish. And over the last 10 years or so, out of the financial crisis, 3 periods when the S&P 500 has gone below the 200-day moving average, it's really turned into a real correction. But there have been a few times where it's just been a brief blip down. But either way, this chart suggests that there could be some more weakness ahead for the S&P 500. And confirming it is a weekly chart of the VIX, another chart within the Bloomberg #BTV 4796. We see that the VIX has been trading over the last 10 years in this long-term trading range to the downside. The question is whether or not it's going to pop all the way to the top. Only time will tell. There is some possibility that it could just go toward the middle, but again, there is a possibility it could go right to the top. And lastly, when we take one last look and tie all of this into the jobs report, which was a bit of a Goldilocks report, not too hot, not too cold, just right, and stocks had been mainly higher on it for most of the day, we see that the jobs in non-farm payrolls in white, the S&P 500 and Aqua, traded into a bit of a range together over the last several years, but it appears that the S&P 500 is coming back down from the top of that range, perhaps again suggesting that there could be some weakness ahead for the S&P 500 and perhaps a bit of risk off into the election.
All right, Abigail, great stuff. Lots about stocks. I love it. It's Abigail Doolittle.
All right, let's get some more insight into the jobs numbers that came out this morning. Michael Feroli is the chief U.S. economist for JP Morgan Securities. He's also a former economist at the Federal Reserve Board in Washington, D.C. The number that obviously jumped out immediately was that 2.8% year-over-year wage growth, fastest pace of wage growth since the crisis. Is there more of this to come? Are we going to see more signs of wage pressure, perhaps general inflation in the months and quarters ahead?
Yeah, we think so. I think you're seeing a lot of signs that the labor market is tightening. So we're seeing a lot of not only the average hourly earnings measures, but most measures, employment cost index, starting to move up. Now, that being said, we're not looking for a rapid acceleration, but it is moving in the right direction, given the types of job growth numbers we're seeing, given the move down in things like the U6 underemployment rate. We think that should continue in the foreseeable future.
when we look at these numbers today, obviously we had a Fed meeting earlier in the week, didn't raise, kind of put a little tiny bit of language in there that might suggest they're getting ready for December. This is pretty much right on track with that. Is there anything within here that they're going to have to take into account that's a surprise at all?
So, first thing about today's number is it generally was very close to expectations, not only ours, but the markets. Not only close to expectations, but close to what the job market has been delivering over the past few months. So not much is that surprising. As you mentioned, the wage number was a touch hotter than expected, and so that will give maybe a little bit of more concern to some of the hawks and centrists that they're getting behind the curve. But I think absent some big surprise over the next 6 weeks, I think they're pretty much on course for a hike in December, even if we get a little bit of a disappointment, I think, in the November jobs report. Again, given how consistent not only what we saw earlier this week from the statement, but also the rhetoric from Fed speakers today with Lockhart, but over the last few weeks, December really seems pretty locked in again, unless we get something really out of left field, I think.
I like what you said, absent some big surprise. Maybe the surprise will be on November 8th, next Tuesday?
Possibly.
If that happens, how will we know how the Fed's thinking has shifted or changed? Will it come through Fed speeches by Fed officials?
I think so. That would be the first place you'd see it. Certainly wouldn't be in the minutes, because the minutes are going to reflect what's happened before the election. So I think the thing they're going to be watching, first of all, is the market reaction. Do financial conditions have a bad day after the markets, after the election, and in the weeks after the election? So I think that's going to be the first thing. How the economy plays out is going to depend not only on the presidential election, but how the president-elect and the incoming Congress are working on fiscal policy. But I think for the Fed, it's really going to come down to the market reaction.
So Joe mentioned that you're a former economist with the Fed board in Washington. How do Fed economists view things like the jobs report differently than an economist at J.P. Morgan would? I mean, how do you take into account these inputs, and how does it influence how you assess the economy?
So I would say at the Fed, I think they have a little bit of a longer horizon than people in the markets. We're always focused on the most recent data point. I think they have the luxury of kind of smoothing through a little bit. But other than that, look, we all study the same economics, so I don't think we're seeing the world radically different from the way the Fed is. And they're obviously being very transparent now about how they're thinking about the economy. So I don't think they're seeing it all that differently than we are.
Let's talk. Scarlet mentioned the election, and I guess it's not really that controversial to say, if there was a Trump victory, we might get some more market volatility, if only because it upsets the current status quo. But there is a potential major change in economic policy ahead under his under his theoretical administration, less in favor of free trade, perhaps much more fiscally profligate with both tax cuts and spending. What do you see as the sort of combined ramifications in sort of an economic policy regime where Trump would be able to get what he wants done, assuming he could?
Yeah, I think the key word here is uncertainty. We don't know how strident he feels about these trade issues, whether he would use executive actions to put in place some of those trade policies from day one.
But let's imagine there really were a regime change where a lot of the accepted dogmas of economic policy for the last 30 or so years really were to be shifted. Like, what would be, let's just say, even if it weren't Trump, let's just say that we had a change on some of this front. What would it mean?
Right. So first of all, I think a lot of the changes on regulatory policy or on trade policy are things that are probably going to affect the economy over a number of years. These aren't things that are going to affect the cyclical, bounce or whatever we're going to see next year. I think that comes down more to fiscal policy, trade, tax and spending policies. There again, he's talked, as you mentioned, about large tax cuts. But he's got to work with Congress on some of those things. So I think you also have to keep that into consideration, which is why I said uncertainty is what I think would really prevail if we were to see a Trump victory.
Let's combine today's numbers with the politics conversation as well. Obviously, the two candidates here had polar opposite reactions to the numbers, as we just show coming into the segment. Is it possible that one of them is just completely wrong, or is there some is there some part of the data here that's up for interpretation?
Well, I'm not going to go there in terms of whether one's completely wrong.
He's trying to draw you into a political debate.
Look, the data is always open to interpretation. I think, though, most people, from what I've seen, have read this number pretty similar to the way we saw it, which is it was right down the fairway. Which, whether that's good or bad, I think you can take your own judgment. But it was not a big surprise. I think it's consistent with, kind of steady 2% growth like we've been seeing.
Let's say before the December report, we get like one of those huge ones. I think it was back in May that we got that big miss, and then that kicked out expectations of a hike several months ahead. Could we repeat that where we get a big miss and then we're back at like June 2017 for the next hike?
It's possible, but I think you're talking about you need a really big miss. May was a big miss, but if we're just like 100,000, let's say, on payrolls for November, I'm not sure that would be enough of a miss to get the Fed off course. Again, provided that political concerns are off to the side.
All right. Michael Feroli, J.P. Morgan Securities Chief U.S. Economist, thank you very much for coming on.
Thanks.
All right, the S&P 500 has turned lower for the day. It's just a slight drop, just into the negative column. But you can see there that it's been a fade since about 2 p.m. Eastern time. And if you come inside the Bloomberg, we can really show you how the move has progressed over the last 9 days. So we were looking at, when it was 8 days long, the longest losing streak since the 2008 financial crisis. You can see we did have a little bit of a lift here following that Goldilocks jobs report, but those gains have faded, and we're down about 3% over that period, which, as Tanya Chen, our producer, noted, was about the points that Clinton lost in polls during that same period.
So, very interesting.
Coincidence or not? This is Bloomberg.
What'd you miss? Steve Ballmer this week on Bloomberg Studio 1.0. Bloomberg's Emily Chang sits down with the former Microsoft CEO, and they discuss his move from the boardroom at Microsoft to the basketball court as the current owner of the Los Angeles Clippers. He also has strong opinions on politics this season, but he might never tell you what exactly they are.
It's interesting to hear you be so optimistic about the government, given the presidential election that we are currently in right now. I know you typically vote Republican. What is your thought on this?
I've never said that, and that I am a definite independent. I'm not registered with either party. I am an independent. I care about issues deeply, and I'm willing to vote for anybody who shares my interest.
What do you think a Hillary Clinton presidency would mean for innovation, jobs, the economy? What would a Donald Trump presidency mean for those same things?
I've read their tax plans. I think that at the end of the day, neither one of the plans have much to do with job creation, frankly. I actually probably am a little less convinced that federal government action or local government action has anything to do with job creation. I think job creation comes out of productivity gains, which comes out of innovation.
Do you think that this election has become too much about not the issues, and not enough about what's important?
Number one, I think this election's become a lot about personality. And I'm sure that should always be a little part of things, but I think on both sides, that's really been blown up.
We've seen so many people in Silicon Valley and the tech industry come out saying that they are against Donald Trump. They are voting for Hillary Clinton. Why not be more public about it?
I would advise most CEOs to keep their political opinions to themselves.
Why?
They're going to be running their businesses under either administration. Their shareholders may not agree with their views. Companies should represent the views of their shareholders. And whatever happens, probably at least 40% of people will vote for either of the two candidates. So I don't really think that that's a good thing to do. Companies should stand up for their issues, but I don't think they should pick candidates. Or at least I wouldn't want a company in which I am an investor to do so. As a private citizen, I'll vote my mind. But the thing I'm going to emphasize is the issues I care about and the facts.
Steve Ballmer on politics. As for Microsoft's failed $55 billion bid for Salesforce back in 2015, Steve Ballmer has said that he could never, ever make the math work. So Emily asked him what he meant by that.
It's too expensive. I mean, it's a fine company. You know, is it a great company? I don't know. It's a fine company. But in my opinion, relative to earnings potential, it is dramatically overpriced. That's just my opinion.
Do you think they're headed for a disaster, or
the company's headed for a disaster? In my worldview, at some point in time, the market will ask companies to make profits commensurate with their market cap. Now, Amazon doesn't either. They have great potential. It's a great company, great company. When will the market demand that? Can't say. When will it demand it from Salesforce? Can't say.
Is Amazon getting a pass from Wall Street?
They are, because people, I think, believe powerfully enough in the future of earnings. But you can't tell me over the long run earnings and market cap are divorced. That sort of runs fundamental to my basic view in capitalism and the way it works.
That was Steve Ballmer, the former CEO of Microsoft, speaking with Emily Chang. And you can watch all of that interview this Sunday on Bloomberg Studio 1.0. That's at noon Eastern Time, 9 a.m. Pacific. It is time now for the Bloomberg Business Flash, where we look at some of the biggest business stories in the news right now. Glass Lewis is opposed to the proposed $2.3 billion merger between Tesla Motors and Solar City. The advisory company, or group, I should say, cites a lack of independent oversight and describes the deal as a high-risk, non-core acquisition. That's in contrast to a recommendation earlier today from fellow advisory firm Institutional Shareholder Services, which said that shareholders of both Tesla and Solar City should vote in favor of the proposed deal. CBS CEO Les Moonves has opened the window to a possible merger with Viacom, saying he's optimistic a deal could work if structured correctly. Moonves tells investors that the broadcaster is in the early stages of exploring a deal after reporting better than expected quarterly sales and profit. Both companies are controlled by Sumner Redstone and his daughter Shari, who have said that they want them to recombine. Saudi Arabia didn't threaten to increase oil production if other OPEC members refused to fall in line. The oil cartel's Secretary General officially denied a report today that the Saudis plan to raise output if other countries did not agree to cuts, saying that instead talks held in Vienna last week with member nations were, quote, constructive. Oil extended its losses earlier today after the original report from Reuters. And that is your Business Flash update.
Up next, do you know who this baseball player is? A tweet about his retirement spread momentarily alarm in Japan's online financial community. We'll tell you why next. This is Bloomberg.
Scarlet, what'd you miss? Well, if you were at work today, you might have missed the Chicago Cubs and the players enjoying their victory lap today. Of course, there are tens of thousands of elated fans in downtown Chicago as the Cubbies celebrated their first World Series victory in 108 years. So this was 108 years in the making. Of course, when you talk about the World Series, it was a classic series. It went 7 full games, and Game 7 was incredible. Two franchises that had gone decades without winning the championship come from behind rallies, a rain delay, extra innings, and of course the payoff is in record numbers of viewers. So here's the early estimate of how many people watched the game. According to Fox, 40 million people watched Game 7, and this is incredible given that it went well past midnight on the East Coast. You could see how it compares to the other World Series in the last 4 years. The Giants and Royals in 2014, nowhere close to the levels that we got in Game 7. Of course, last year when the Royals played the Mets, it didn't even get past Game 5, unfortunately for Mets fans. So this was a pretty blockbuster ratings number for Fox. And of course, they also got some political ads in there as well in Game 7. Both Donald Trump and Hillary Clinton ponied up a lot of money for ads. And I think Hillary Clinton's campaign spent money for a 1-minute ad, which was pretty telling.
Also, it's kind of fascinating because the NFL ratings are down this year. So maybe there's some sort of a regime change going on. Maybe next year we'll see.
Well, one of the reasons is because the NFL games have not had great matchups.
Right.
And this was a classic matchup, Indians versus Cubs.
So you got to put out a good product.
Yep.
It turns out I'm also kind of talking about baseball and also about a tweet and also about the danger of relying on Twitter unfiltered for news. This was a tweet that went out at like 1 o'clock in the morning. It was in Japan. And you probably, unless you speak Japanese, you probably can't read that. But the translation by Bing, which, you know, whatever that is. It says, Kuroda has regard to resign, an urgent press conference. People thought that the Bank of Japan governor had announced an urgent press conference to resign. That was not the case, but this tweet got picked up all over the place and was retweeted by multiple people in the financial community online in Japan. And then it had to be clarified really fast. It's just about a baseball player, Hiroki Kuroda, who used to play in the MLB, now in the Japanese leagues. He held a press conference regarding his retirement. Nothing to do with the Bank of Japan, but it shows how quickly you could see something and react to that. And
well, let's not assume that maybe this was misinformation. Maybe they just found his retirement to be, you know, a big move for the macroeconomic outlook for Japan.
Maybe it had significance.
All right, I feel like I don't have a Friday chart, but this is going to be looking at something not baseball related, but I think it's important because this is what's happening right now with Fed funds expectations for a rate hike, which is what we're looking at basically in the blue. The purple right below it is the VIX, so we know the volatility has been shooting up in the S&P 500. We know that the rate hike expectations have also been moving up as the data has been solid. But here's what's curious. The white line here is the the blue line is the Real Clear Politics Trump average polling, which is also moving quite a bit since that new email situation arose last Friday. So basically the question here is something mispriced. If you are of the belief that a Trump election could derail the Fed's expectations, then something's not right here.
Well, in 2 days, we won't have to ask the questions anymore. We'll just see what happens.
All right, meantime, let's get you an update on how stocks fare because at last check, the S&P 500 had given up its gains. It is now down 0.1%, extending its losses to a ninth straight day. This is Bloomberg. closing bell. What'd you miss? U.S. stocks flirting with a 9th straight decline. The VIX also on its 9th day of gains. It would be the longest rising streak on record for the VIX, with 2 more trading days left to go before Election Day. I'm Scarlet Fu.
I'm Joe Weisenthal.
And I'm Oliver Rennick. And a special welcome to the Twitter followers, where you can follow along with Bloomberg Live every day from 4 to 5 p.m. Eastern Time.
All right, we begin with our market minutes, and of course, we need to start with that streak for the S&P 500. It does look like for the S&P 500, which gave up its gains from earlier, this is a 9th straight day of losses, and at 8 days, it was the longest losing streak since 2008, the financial crisis. At 9 days, we're now looking at the longest stretch of losses, daily losses, since December of 1980. That is remarkable, a 36-year record there when it comes to the longest stretch of declines. And in terms of industry groups today, you're not seeing a whole lot of decisive downward action, because you still have 5 groups in the green. Healthcare, real estate investment trusts doing better. The big loser here was consumer staples, followed by energy shares.
That's kind of been the nature of many of these losses, which is that they haven't been that dramatic. I mean, it certainly doesn't feel like we're cratering or anything.
That's the big
in this
difference.
market. Yeah, absolutely.
We're sliding
right.
slowly, but not steeply.
Slow grind down. Yeah.
And of course, we should mention as well that the magnitude of the loss for the last 9 days is not extreme. It's about 3%, which could have happened within 2 days or 3 days. It really speaks more to how people are a little bit reluctant to do very much with their positions leading into this election.
And I would just add that off the highs from August 15th, it gets down to about closer to 5%, down about 4.7%. But of course, we've got some pretty big headline events coming up that could shake up that volatility even more. So we're almost halfway to a 10% correction here. I'm going to check out stocks a little bit deeper by looking at some sectors. You mentioned that it's kind of been mixed today. There are a few that stood out in particular. As you said, we had healthcare doing pretty well, and then we also had some pretty good strength in the real estate space, looking at REITs. Now, I'm going to go back to that deep dive I just had a minute ago, where you have these very dividend-specific sectors that seem like they've sold off quite a bit, even as Trump has done well, where, again, if you're of the belief that he could potentially derail the Fed by winning, you'd think that maybe some of these dividend stocks might pare back some of those losses and reverse the trend that they've had. Anyway, I thought that was interesting. Consumer discretionary led the way, was one of the biggest losers on the day, down about 20 basis points. I don't want to read into this too much, but there's these sectors are pretty election sensitive as well. Moving to sectors just real quick, pretty big volume on food and staples today as those groups were losing. And then biotech, pretty good volume as well, both about 40% above the average. And then finally, we can't not talk about the VIX because it keeps going up. Wow. And now we are at 23. Typically, the VIX historically is about 20% higher on average in the month of November of election years. And we're getting close to the 24 range, where the Fed has never risen rates with the VIX above 24.
Good.
All right, let's take a look at government bonds, because the real story today, or one of the stories today, was that jobs report, which was pretty good this morning, particularly on the wage front. Came out at 8:30. You're looking at 2-year yield, initially popping higher on the report, but eventually sliding, decline. So people buying bonds today as we got this market sell-off. Now let's look at 10-year yields. Kind of a similar story there. Initial jump briefly with yields going positive on the day after that 8:30 report, which was characterized by unemployment going down to 4.9%, wages growing 2.8% year over year. But as you see, yields there going out on the lows of the day. And real quickly, commodities, you got to check out oil, because it's been pretty rough lately. This is a 1-month chart of West Texas Intermediate crude. It had been over 50 in the middle of the month. People were getting pretty excited about OPEC coming together and the market coming into balance and all that stuff. But it's been pretty ugly. It's down 9% now for the month, below $45 a barrel for West Texas Intermediate. So not a pretty scene right now in oil, as people are skeptical of OPEC being able to get it together.
All right, and let's go to the currency market. The U.S. dollar, as measured by the Bloomberg Dollar Index, got a brief lift from the jobs report, but as you could see, it was pretty short-lived. Traders said that the market had already priced in a December rate increase, and this jobs report certainly paves the way for that rate increase. So concern about the election really dictates where the currency market and the dollar in particular goes in the short term. And you can see that we're just at session lows right now. The other interesting trend we've noticed of late is the Swiss franc becoming a safe haven with all the election uncertainty. It was stronger against all the major currencies except for one of them. You can see here stronger versus the dollar, stronger versus the euro as well. Those are today's market minutes.
All right, I want to bring in Matt Boesler. Let's talk about that jobs report this morning. Seemed pretty good, particularly a lot of people talk about the wages number. You've brought with you some charts. This first chart is sort of one of your favorite ways of assessing the labor market. Aggregate weekly payrolls change. We got to hear. Let us know what do you see?
Yeah, so a big debate right now is whether job growth is slowing down because the labor market is approaching full employment, and therefore we're just kind of running out of workers to hire and that sort of thing. And so if that's the case, then you should see wages start to rise like we did in today's report and kind of pick up the slack in this line, which shows you employment times hours worked times hourly earnings. So this is kind of your aggregate paycheck, and this is a year-over-year growth chart.
America's paycheck.
Right, and you can see that we've got two very different signals from what's supposed to be essentially the same measure of aggregate weekly payroll growth here. The white line actually slowed to the slowest since February 2014.
I might be able to zoom in there.
Exactly. So what that is that's the production and non-supervisory series in the jobs report. So that's 80% of employment. And this used to be sort of the old headline measure, and then about 10 years ago they introduced this new one, which adds the other 20% of employment back. That's the blue line. So basically what we're seeing here is we have these two different data sets from the same report, kind of telling us different things about what's actually going on with wages. And so we'll just have to see.
So as always, the debate continues till next month.
That's right.
All right, I got a good chart that you brought here looking at employment within a certain demographic. And I think this is really interesting. So basically what you're looking at is a plunge in the 45 to 50-year-old non-employment rate. So I think this is interesting because there's a great story in Business Week coming out this weekend about how important 40-somethings are to the economy.
Gen X.
Exactly. Where you've seen higher productivity when these people are involved in the workforce. So how good is this?
I think this is the most positive thing that we saw in the jobs report today, because this is really, you can see that red line there shows you, like, it just projects back so you can compare it to previous cycles. And before this massive plunge that we've seen over the last 2 months, this was very high. And so we had a lot of 45 to 54-year-olds who lost their jobs in the recession. They were out of work. And, there's not a lot of hope for these people, right, when we usually talk about, like, can they retrain, can they go back to work? But we're starting to see them actually come back now, and we're finally getting down to levels, that are consistent with previous expansions, which is just, like, massively good news.
So between this and the wages, you start to get a picture, it seems like, of a labor market that's starting to pull in people who are, getting tight and pulling more people back in.
But you wonder what kind of jobs those 45 to 50-year-olds are getting, whether they're the quality jobs with high wages or perhaps some of the jobs that used to go to teenagers working at a fast food restaurant, for instance. Your third chart that you brought in today is jobs in high-wage service-producing industries and looking at how that compares to other kinds of jobs. And what's notable here, Matt, is this blue line, which is kind of the outlier, which is jobs in low-wage service-providing industries.
That's right. So you can see in this chart that in this expansion, really like a major driver of job growth has been these low-paying jobs, and we've heard a lot about that. And so even, relative to previous cycles, it's been, much faster. And now that's starting to come down a bit. The red line is those high-paying service industry jobs that we think about, like lawyers, accountants, scientists, that sort of thing.
White-collar professionals.
And I think it's really important to note here that that is really staying steady while, like, the blue line and the green line, which are the lower-paying jobs, are actually decelerating now. And so this is actually another reason why average hourly earnings growth is picking up, because the composition of employment growth is being tilted toward higher-paying jobs now.
Speaking of average hourly earnings growth, how does wage growth feed into inflation? What's the consensus thinking on that? Does wage growth lead inflation? Is it coincident? Does it not really move in tandem? Like, does the Fed look at that number and feel more confident that it'll be able to get broad-based inflation? How does it all work?
Yeah, I think they look at those lines and they like to see them both moving up together.
Right.
But I would say there is no consensus on how this works. There's basically two ways it could work. One is that you get higher inflation, and then that allows businesses to raise wages or workers to demand higher wages because there's higher inflation. The other way is, wage growth goes up, and so workers have more money to buy goods, and therefore the prices of goods rise. So that causality, it probably runs in both directions. There's no real clear consensus on which is the driver.
All right. Bloomberg's Matt Boesler, thanks for breaking it down with us.
Thank you.
A deep dive into the jobs report. All right, let's just recap what happened with U.S. equities. The S&P 500 falling for a 9th straight day. It is now the longest losing streak in more than 3 decades, going all the way back to 1980. You can see there, this is today's price action. Equities really faded into the close. Since this streak started, if you want to come inside the Bloomberg, real estate and healthcare were the biggest lagging groups in the S&P 500. Real estate investment trusts down 5.5%. Healthcare shares down by better than 4%. Every industry group declined, but utilities and industrials held up relatively well compared to some of the more interest rate sensitive, like real estate investment trust sectors. Actually, utilities also very interest rate sensitive. So interesting how that worked out.
It's very interesting. A lot of losses across the board. I'm going to look at some technical stuff, which is pretty interesting. One of the few technical measures that I like, because it's just simple math, is basically the relative strength index, which measures how quickly things sell off or how quickly things rally. I want to call your attention to the bottom panel here, which is looking at the number of companies with an RSI below 30 in the green, which means they're oversold, which is a good thing. They should mean revert if you ascribe to this theory. And the red, which is those that are overbought. This is basically the trend we've seen since this market started to sell off a bit, where now you have the percentage of companies in the S&P 500 that are oversold is greater than 15%. On the flip side, there's very little, there's a very small amount of companies that are actually overbought. So if you're a technical person and you want to try and find value here, this would indicate to you that things have moved a little bit too far, too fast. Then again, you know, overall in the big picture, we're not down a ton.
No, that's the
off
thing.
the high.
We're not down a ton, but it's interesting because typically what happens is that before you have a presidential election, stocks tend to rise into that vote, and we're not seeing that this time around.
And when they don't rise, it tends to suggest that the non-incumbent party, the challenging party, will win.
All right. We'll, of course, be dissecting this further. We're also going to dissect the foreign exchange market as well. This is Bloomberg.
What'd you miss? Election angst, not just in the stock market, but also in the foreign exchange market. The Bloomberg Dollar Index weakened for a 6th straight day, its longest losing streak since March. For more on that, I want to bring in Alan Ruskin, Global Head of G10 FX Strategy at Deutsche Bank. Alan, thanks so much for coming. I want to start off with a very simple chart in my terminal that is showing average 3-month volatility among different swaps with the dollar. It's a small move, but it's a move nonetheless, and you can see in the past couple weeks here that trend up about 10%. This is dollar versus yen, dollar versus yuan, euro, all kinds of stuff. So what's behind this?
Yeah, obviously election uncertainty is the big story. It's a big story, but I wouldn't go too far with it, to the extent that when you look at some of the longer-dated volatility and the way that's trading vis-a-vis the euro, the yen, etc., you actually see like one-year volatility is not really tracking up that substantially. So people look at the volatility, they think in terms of election uncertainty, that's effectively driving short-term volatility, but they don't really see it extending that far into the future. And really the same story you see in the VIX, for example. When you look at the VIX 6 months forward, same story there. The anticipation is that vol's not going to continue rising.
So in terms of how that translates into something actionable, then if you are an FX trader, do you expect this to come back down? Do you start to short some of this volatility that's emerged?
Well, I think vol will probably come off somewhat, once we get rid of some of the election uncertainty. Obviously, depends on who's elected, right? There is a broader story there that I think if you went from a Brexit vote to then a Trump victory, that the market would think, look here, we're underpricing political risk in general, and that there's something strategic there. And I think that optionality would be something people want to own. That's number one. Number two, we obviously saw a flash crash with sterling as well. So that's another reason to actually want to own optionality.
Going into, obviously a lot of people are likening this election to the Brexit vote. We saw what happened in the aftermath, huge risk-off move across the board, and then many of those moves erased. It feels a little different this time in the sense that, well, because we had Brexit, everyone is kind of hedging for that possibility. It feels very different than pre-Brexit because it felt then more like we were sleepwalking into that, and then bam, that happened. Whereas this time, everyone is kind of aware that that risk is out there.
Yeah, no, we did more than sleepwalk. I think we actually walked, bam, into the crash, really. I think if you remember what actually happened on the day, right. Of course, the market was very much trading against Brexit.
Up until those final few minutes, we saw a surge in risk assets until it started becoming clear. And then
exactly. I mean, sterling went from, I don't know, it was like something like 143 up to 150, down to 130 kind of thing. So that was particularly wild. But yes, I mean, the markets learn from events, and the market's taking a very cautious line on this. They, I think, have learned that you can't trust the polls completely.
The Brexit also taught us how to use the Swiss franc, because the Swiss franc held up certainly as everyone was fleeing risky assets, but even as everyone came back into risky assets, the Swiss franc held up as well. So a lot of people are saying that it's a perfect hedge for the U.S. election. Certainly it would climb if Trump wins, but it wouldn't necessarily crash if Clinton wins as well. Are you seeing that kind of demand for the Swiss franc?
Well, I think you are seeing that kind of hedging-related demand. I'm not sure it's the perfect hedge, because I think if Clinton wins, dollar Swiss does go up. But I think what you are seeing is the market is generally testing Euro Swiss on the downside, testing the Swiss National Bank's resolve to hold that 108 line. They've kind of seemed to be giving way a little bit. And if you have, say, for example, a Trump win, and you've got all the European uncertainties as well, then the Swiss is going to look great, really. And I think the Euro-Swiss downside floor that the Swiss National Bank's putting in there is really at risk.
Yeah, I want to, if you have the Brexit, Trump, as you mentioned, then suddenly our imaginations open up and we start to see where else could we have political turmoil. Where is the, we might want to reconceptualize what considered a safe haven. You mentioned Switzerland. Where else is a political safe haven where people might want to park some capital amid a time when we don't know what's going to happen?
Yeah, well, ironically, really, I mean, it's Japan, I guess, right? You've got a relatively homogenous society. You're not dealing with the intra-country politics that you have in the euro area, so that kind of tends to rule the euro area out completely, or most of those countries out completely. You've got the United States, which is problematic, or potentially problematic.
What about Kiwi? There was an interesting Bloomberg story about all these rich people,
the billionaires
moving to the end of the world to escape geopolitical risk and populism and all that. Is that the kind of currency that people might bid into just because it's so far removed from all the chaos other countries are
Yes, no, I read that story, and it rings true, I think. There's a sense that there is some flight or movement in that direction. Keep in mind, you have a small country and relatively small demand for that currency generates quite a big price movement. That said, the Kiwi is probably the most overvalued currency out there. So, that's the caveat. You don't want to trade short-term currencies on this long-term theme.
You can get protection at the end of the earth. You just got to pay up for it.
Exactly. Right now, at least. Yes.
What about a currency like the Australian dollar? I mean, we've seen how the commodity boom and bust has stabilized somewhat. Is there reason to find a safe haven quality in the Aussie?
Normally it's the high beta currency, so absolutely not. You're normally looking at something like Aussie yen, where the yen's the safe one and the Aussie is really the high beta trade. This time around, I think people are, one, looking at the Chinese credit cycle and saying, okay, well, the economy seems like it's going to do okay for the next year or so, so, the Aussie's safer on that score. And then I think people are also pricing out rate cuts in Australia as well. So the combination has actually ended up with a very, very firm Aussie dollar, surprisingly firm in an environment where risk is actually challenged.
Alan, I want to get an update on something you mentioned recently when you came on the show in late September about strength in the Japanese yen. Apart from a little bit of dollar weakness, well, quite a bit of dollar weakness we've seen in the past week here, the yen was getting a little bit weaker. What do you want to see from the Japanese economy and the signals from the Japan side of the equation? We've talked about what's going on in the U.S. What is going to happen from Japan's part of the equation that will strengthen their currency versus us into the end of the year?
Yeah, it's not totally obvious. I think it's really more a case of if you see this yen strengthen just a little bit and you start to see dollar yen go below 100, it will strengthen quite a lot more, because I think you'll again see that hedging activity, effectively a purchases of yen taking place by Japanese investors really as they hedge their foreign portfolios. So it sort of becomes a self-fulfilling story, but I think we need to go actually below 100 to kind of regenerate that. Right now the Japanese economy is doing okay. It's just ambling along at a relatively slow pace, but I don't think it's decelerating. It's not necessarily accelerating.
All right, got it. Alan, you're going to stick with us because we've got more. That's Alan Ruskin, Global Head of G10 FX Strategy at Deutsche Bank.
All right, we have Berkshire Hathaway reporting earnings, as is typical. It does so on a Friday afternoon. Operating earnings per share of $2,951. That is lower than what analysts had been looking for. They anticipated $3,058 for third quarter operating earnings per share. The net profit for the period was $7.2 billion. And we should mention as well that Berkshire Hathaway ends the quarter with cash and cash equivalents at $84.8 billion. That's pretty unbelievable. This is Bloomberg.
We're back with Alan Ruskin, Global Head of G10 FX Strategy at Deutsche Bank. Alan, thanks for sticking with us.
Oh, my pleasure.
I want to keep on politics because that's all anyone cares about right now. Obviously, if we have, it's possible that you could have some sort of risk-off event on the uncertainty of a Trump victory. But let's look further down the line, and let's open the possibility that we could have like real economic policy regime change, much more fiscally liberal government, a government much less inclined to pursue trade. What is the economy and what do financial markets do if we get this sort of shift in consensus?
Yeah, well, I think the market's thinking that there are two big issues, really, and they conflict to some extent. So there's the trade story that potentially is a risk-off phenomena, and then there's a fiscal stimulus story that is potentially very strong in terms of at least front-loading growth early into the new administration as such. So, I think that the market's underestimating that latter story. It's, I don't think it's necessarily Reagan-esque, really, but you could have a very large stimulus where corporate taxes are cut to the point where there's a whole new corporate tax structure, not just for the United States, but it'll open the door worldwide.
So what does that do for rates in the dollar?
Well, I think you will see at least the back end of the curve sell off. I think it's probably going to sell off regardless. So back end yields backing up, potentially quite substantially. And then it's really a case of what the front end does, what the market expects in terms of the Federal Reserve. But if you have a combination where you have this very expansionary fiscal policy and a credible central bank, then you tend to have this yield curve that typically flattens out. It's a bear flattening as such. That's the perfect environment for the dollar. So really, it's, it harks back to a time when I started my career, really, in the early 80s, where, effectively the dollar was really on a tear, and a lot of it was really about a fiscal expansion.
That's great. I have a burning question about the Mexican peso here. So let's come into my terminal real quick, just to kind of give some scope of what's been going on, because this has also been very politically focused. Here's the move down we've had in the peso since about May, about 10% relative to the U.S. dollar. Now, a lot of people are attributing this to the Trump situation. You take this chart back 5 years, this curve has been going down since 2013. So are we in a situation here where the value of the peso has been pushed down because of election politics and you can get poised for a rebound in that, or should you just steer clear of this 3-year momentum of losses?
Well, I don't think the peso's trading has been anything but awful, really. It's shocking how the trade accounts have not responded at all to the weakness that we've seen in the currency. That usually puts a break in terms of weakness. We haven't really seen the trade accounts turn around. So what you have when you look at fundamental value is you look at a variety of different measures, things like PPP, for example. You throw in productivity in terms of trade. The Mexican peso looks very cheap. Then you throw in the external accounts, the fundamental exchange rate equilibrium. You throw that in, and it's all of a sudden, wait a minute, this actually could be expensive. So, I generally would say, this is a currency that looks fundamentally weak.
Okay.
All right, Alan Ruskin, Global Head of G10 FX Strategy at Deutsche Bank. Thank you very much for your perspective.
Thank you.
Up next, what happens to GOP leaders if Donald Trump loses? It's a risk they're willing to hedge. We'll have those details. This is Bloomberg.
I'm Mark Crumpton. It's time now for First Word News. Hillary Clinton has a 3-point lead over Donald Trump in a new national poll. The former Secretary of State tops Mr. Trump 47% to 44% in the ABC News Washington Post tracking survey. Meantime, voters trust Clinton to handle the economy and health care. Trump has the edge among voters when it comes to dealing with corruption in government and immigration issues. President Obama has pardoned 72 more federal prisoners. The White House says many had been jailed on drug and weapons charges, though more than a dozen of them were serving life terms. The president has now commuted the sentences of 944 people, more than any other U.S. president. In New Jersey, a jury in Newark has found 2 former allies of Governor Chris Christie guilty of plotting traffic jams in the name of political retaliation. Jurors convicted Bill Baroni and Bridget Kelly on all counts. They were accused of intentionally creating the chaos at the George Washington Bridge over several days in September of 2013 to punish a mayor who wouldn't endorse Christie's 2013 re-election bid.
When people do things in government, when they do things when they are supposed to be serving the public, and they take actions that in fact undermine the public's confidence in our ability to do our work because what they have done is so far over the line and is illegal that we have to seek them out and we have to see that they're punished.
Sentencing is scheduled for February. Both defendants say they plan to appeal. The Paris Agreement on climate change became international law today, coming into force faster than anticipated. It ends a year of success in international efforts to reduce emissions of carbon dioxide and other global warming gases. Under the deal, some 200 countries agreed to move economies away from fossil fuels and to limit global warming to 2 degrees Celsius or 3.6 degrees Fahrenheit. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Scarlet.
Thank you so much, Mark. Let's get a recap of today's market action. Jitters, pre-election jitters, sending stocks down once again. For the S&P 500, this now marks the 9th straight day of losses. That is the longest losing streak since 1980. Yesterday, when it was an 8th straight decline, it was the longest losing streak since 2008. During that period, however, it's not like stocks cratered. They were only down 3% if you look at the S&P 500. Yes, every industry group declined, but we're not looking at momentous losses. At the same time, we saw treasuries rally, we saw the VIX climb, we saw oil decline, we also saw the dollar weaken as well, even with the jobs report that, for the most part, keeps the Fed on track to raising interest rates in December.
You know, red on the screen, but at the end of the day, at least there's some consistency on the week, right? Down, down, down.
Right, at least we can be grateful for the consistency.
All right, what'd you miss? Dallas Fed President Robert Kaplan said the impact of wage growth on prices may be muted. He spoke to Bloomberg's Mike McKee earlier today from Mexico City.
This is another data point in a trend of moving toward full employment. I think the 3-month, 6-month averages of job growth are in the 170s, if you include this number in the September revision. Very consistent. So I think this is just steady progress toward removing some amount of labor market slack and moving toward full employment.
You got a strong gain in wages, 2.8% annual rate. Are you convinced now the Phillips curve is back, that we've absorbed enough labor slack to generate some inflation?
So historically, when you had this type of wage growth, it would wind up finding its way into prices. One of the trends, the secular trends that's going on, is technology-enabled disruption. I mean, it's harder for businesses to pass on cost increases in the form of prices. Businesses have less pricing power. So I'll actually be very interesting to see how much of this wage increase finds its way into prices. I think it's going to probably be more muted than we're historically accustomed to.
Well, the market is looking at these numbers and saying the Fed is going to raise rates in December. You didn't put an explicit hint in, as you did last year, right. But is there any reason to think that that's not going to happen?
Well, as you know from talking to me before, I usually don't speculate on any individual meeting.
But I want you to.
But I've said, I think we're at the point where we should be able to remove some amount of accommodation. I think this is in the context of a very gradual, shallow path, much more gradual and shallow than we've ever historically experienced. But I think we're at the point where we, in the near future, should be removing some amount of accommodation. But again, I think the path after that, future removals of accommodation, will be very gradual, and we can afford, I believe, to be patient.
Well, when you look at the markets, are you sanguine about the market reaction to a rate increase, that it is enough priced in that you won't get a taper tantrum?
That's always hard to judge. I watch the market probabilities. I think that if we were to move in the near future, the market seems to have some significant expectation of that. So I don't think that should drive our actions, though. I think we need to be driven by the underlying economy and economic conditions, and that's really the basis on which I believe we should remove some amount of accommodation.
The dot plot put together at the last meeting suggested that the consensus in the Fed is for 2 rate increases in 2017. You're going to be a voter next year. So let me first ask you, where's your dot for the end of 2017?
Well, so obviously my submission was part of those averages. I don't comment on number of increases or timing specifically, but I think the dot plot, the SEP, was very consistent with what I think is appropriate, which is a very gradual, patient path of rate increases. And I think that's what people listening to this should take from what the Fed is saying, and what I'm saying is that I think future path of rates can be very gradual.
That was Federal Reserve Bank of Dallas President Robert Kaplan speaking with Bloomberg's Mike McKee.
Turning to politics, what'd you miss? Donald Trump is narrowing Hillary Clinton's national lead in the final days before the election, thanks in part to growing support from Republican voters. People are coming back home. But Clinton still is favored to win, and Republicans are still concerned about what happens if they lose their 3rd straight presidential election. What is the future of the party? Because that hasn't happened since the 1940s. Here to put this all into context is Sahil Kapoor of Bloomberg Politics, who joins us from Washington. Sahil, if Trump loses, it feels like there's just going to be a huge brawl for the future of the party between his side of the party, which is more populist and nationalist, and the more sort of, free market, arguably more globalist side of the party, perhaps represented by a Paul Ryan type. How brutal is this going to be, and who's going to win?
I think it's definitely going to be painful for the party. I think they're facing a moment of reckoning, unlike those we have seen in their most recent losses in 2012 and 2008, because what Trump has done is he's revealed the extent to which this nativist, nationalist, populist wing is, flexing its muscle in the party, and he's revealed that it has larger numbers than anyone really thought, which is why people wrote him off to begin with, and he's been this successful within the party, at least up until now. And now we see a situation where Republican voters are overwhelmingly getting behind him. He's up to somewhere around 80 to 90%, depending on the poll, of Republican voters, and he's doing better than Paul Ryan is when Republican voters are asked which one of the two they would like to see lead the party if Trump loses. So there's going to be a moment of reckoning between the ideologies. There's going to be a moment of reckoning between the various factions, whether it's the establishment versus the populists, the grassroots versus the donors. There's just going to be a lot of recriminations, I think.
So, Hill, we've only got one more business day here until Tuesday. So let's start to talk about the nuts and bolts of what to look for Tuesday night. Brexit, one of the first places that reported, it seemed like it was going to be stay, and then all of a sudden it immediately, went the other way. What exactly should we be watching? How soon will we get a clear idea of where these votes are coming in? Is there a key state that comes in first? Is there a key battleground area where we'll see that, okay, this, the shoe has dropped here?
That's a great question. So 2 points on that. First is 2 states on the East Coast where polls close early, around 7 or 7:30 Eastern, North Carolina and Florida. Donald Trump needs both of them to stay alive. If he loses either one of them, then he's pretty much toast, and I think we can more or less call this thing early. The polls right now in Nevada are the early vote in Nevada right now, which tends to be pretty high as a share of the electorate. It was in 2012. It is so far this year. It's looking good for Hillary Clinton. If you take that off the map for Trump, I'm not doing that, but it seems likelier than not. If you take that off the map for Trump, he needs to win a state like Colorado, like Virginia, or Wisconsin, or Pennsylvania. And the latest polls we have today and yesterday show Hillary Clinton holding her firewall in those states. So the polls today, I think, are showing a little bit better odds for Hillary Clinton. But again, there are a few days left, and she's got to turn out her base, particularly minorities, millennials, and unmarried women, and that's still going to be a lift for her.
Sahil, I wonder, how do these early votes count? Are they tallied up ahead of time and then the actual votes on Election Day are then added to those early votes, or are the early votes tabulated and tacked on at the very end? Because that influences how we view the results on Tuesday.
Well, the early votes are calculated every day. So at the end of the day, or perhaps the next morning, depending on the state, it goes state by state. So there are idiosyncratic methods for each one. But usually, we get day-by-day results.
All right, Sahil Kapoor, thank you so much of Bloomberg Politics. And, of course, tune in at 7 p.m. on Tuesday. Our Washington Bureau Chief Megan Murphy and David Gura will be hosting Bloomberg's special election coverage. Don't miss that. This is Bloomberg.
What'd you miss? The VIX climbed for 9 days and the S&P 500 posted its longest streak of losses since 2008 ahead of the U.S. election on Tuesday. Take a look at my chart inside the Bloomberg here. This is really interesting. I love this because this is basically looking at the VIX versus realized vol. So essentially what we're looking at in terms of implied volatility versus realized vol. On the far right of the screen there, you can see that popping to a level that it hasn't been since August of last year when we sold off. This basically means that while the market, sure, we've gone down, but the moves have been fairly quiet. We've seen a bump in the VIX, but there's something happening here. There's a bit of a discrepancy, if you will. So joining us now for more to talk about volatility ahead of the election is SP&C founder and CEO Adam Sender. Adam, great to have you here. I want to start off with this chart, which is basically looking at the realized versus implied volatility. Do you look at something like this and say, okay, the spike in VIX we've had in the past week or so is going to have to come back down to normal levels, or is, regardless of who's going to get elected, there going to be some kind of volatility event, in which case you can just bet on higher vol?
Well, first of all, thanks for having me, guys. I think what's going on right now is very similar to what happened during the Brexit. Since last Friday with what happened with the FBI, the probability of Hillary winning has gone down, and basically everybody has started to put on their protection this week. So, my bet would be that Hillary wins and the VIX goes back down to where it was before this all started.
So how does this set us up for Monday, the last trading day before Election Day? And has everyone put on the hedges that they want to, or will there be some last-minute scrambling? We saw the S&P 500, for instance, rising for the most part in the morning and then fading into the close.
Right. Well, I'm going to play long into this event. I think I think the odds are still that Hillary's going to win, and I think there's some fear mongering going on over here. So so what I started to do is I just basically started to scale into a long bet, and I'll continue to do that on Monday and Tuesday, and then basically what we'll do is we'll do what we did on Brexit. We'll watch the results state by state, and if it starts to go badly, then I'll put on a hedge to try to protect myself.
One of the things that's been striking this year is the fact that there have been a series of risks, event risks. There was obviously first Brexit, then this, then there's the Italian referendum. There seems to be, people thought this was going to be a summer of volatility.
Right.
And yet it's really never gotten that elevated outside of the acute moments, like the immediate post-Brexit environment, like a little bit right now, though not too intense. What do you think explains this discrepancy between the way people are talking about the market and the economy right now and the way people are trading the market right now?
Well, I took 2 years off, and one of the reasons I came back is I think we're going from a low vol, low VIX era to a high VIX era. And, that's just basically because, in my mind, everything's about the bonds. Everything's about interest rates. And, to me, bonds are in, let's call it the 9th inning and the 10th inning here. And once interest rates start to go up, I think you'll start to see higher volatility. I mean, the markets are really just basically on a sugar high from very, very low interest rates for a very long time. But, like you said, the volatility has been dreadfully low. I think after the Brexit, we were in a 3% range from, I think it's 80 straight days or something like that, which was the longest streak of tight ranges going back to 93 or 94. So if you're a trader like myself, it's been relatively painful, but I think we are transitioning from like you said, there's too many things going on in the world here where we're going to go from a low vol world to a high vol world.
How much of this low vol world is the result of QE and the central bank buying assets around the world? People characterize that as volatility suppression. Lately, we've seen a little bit of a tick up in rates since the end of the summer. Is that part of this end of this great low vol crush that we've seen?
I mean, that's my opinion. I really, I do believe that. I think these short vol, the popularity of short vol trades. Everybody worships now at the feet of quants. Mm-hmm. And, it's my opinion that that's going to change once we get into a period where, the S&Ps are allowed to move more than 1% a day. When I started trading in 1991, and from 95 to 2000, I mean, the ranges were dramatically higher. The VIX was, on average, probably 20 to 25. So I think we're going to see that again pretty shortly. Regardless who wins the election. If Trump wins, then that could happen immediately.
Right.
If Hillary wins, then maybe it takes a little bit more time. But given the stimulus that probably either candidate's going to do, and then interest rates will go up, we'll probably see that.
Do you think the VIX, or not VIX, do you think volatility is an asset class and people are starting to realize that and treat it as one?
I don't really know, to be honest with you. I think that the people who have been conditioned to short vol on every single rally in the VIX will one day get burnt very, very badly. So exactly what happened after the Brexit, I don't think there was anybody who thought that the market would rally back as sharply as it did. But you've seen that. You saw that last summer in August. You saw that during the Brexit. And one of these times, it's not going to be it's not going to end well. And I think that's where the volatility genie really starts to come out.
People really did not think that the Brexit vote was going to go the way it did. I mean, all the experts and pundits were totally caught off sides. Yep. If Donald Trump were to win, I think that would basically be the same thing, where you have all these people who said this just can't happen happening.
Correct.
Could the combination of two events in which all these experts got it wrong start opening up people's ideas about all kinds of things and just cause people to just sort of fundamentally question a lot of the stabilizing forces at play here?
Absolutely. I mean, if Donald Trump wins, I think everything falls into question. What happens to Janet Yellen? It's just what happens with trade around the world. So the risk parameters should go up dramatically.
So will that validate your decision to come back to the markets and start trading once again if Donald Trump wins?
I am certainly not rooting for Donald Trump to win. So I would actually rather him lose and have a low vol a little bit longer than have him win. I mean, I do think that, I've been watching politics my whole entire life. I was a history major. And this is, I was actually a Republican when I was younger, loved Ronald Reagan. So, but this is the first time in, really my lifetime that I think that this is a candidate who is a danger to the Republic, and, somebody that I would really be scared to be president and be scared for my children. So I would rather him not be president and have some low vol for a while.
So not the sake of the fate of the Republic not worth a few vol points is what you're saying?
Yes,
Probably not.
I would sacrifice that, correct.
Okay. Adam Sender, you're going to stick with us. We're going to talk more. He's the founder and CIO of SC&P. Stay with us as we get to more stuff.
And coming up, we're going to talk about art sellers who are bailing on their investments after an emerging art bubble burst. More art collector with SC&P founder next. This is Bloomberg.
We are back with SC&P founder and CIO Adam Sender. Adam, you're a well-known collector of contemporary art. You've donated pieces to the MoMA in New York and MoCA in Los Angeles. How much of your investments in art is rooted in your search for yield?
Well, when I first started collecting art in 1997, 0% was really rooted. It was just something that I was passionate about and got into, and then became a very avid collector. I think at one point I had about 1,200 pieces of art.
What about now?
How many pieces of art, or am I an avid collector?
No, the yield. Any yield from the artwork now?
I don't really look at it, that way, to be honest with you.
But there are a lot of people who do look at art as an investment. And one thing that's interesting is that if you look at, say, attempts to create indices of art, they often line up with things like zero coupon bonds and gold and other sort of out there assets. What drives art? What drives the price of art?
Well, I mean, I think the way to look at it and to kind of answer where I think things are going is, since the Japanese market crashed in 1991, or late 80s, early 90s, basically art has been in a bull market. And we had a slight correction during 2007, 2008, but for the most part, it's gone up in a straight line. So right now, we have a ton of galleries. We have art fairs every 2 weeks, and basically, there's too many people out there dealing art. And I think you finally start to see the correction in art, where the younger stuff has started to gone down, and really it's the high end stuff that's holding up. But if you're looking at art as an investment, this probably wouldn't be the time that I would be buying art. I think the tide kind of has to come in, and you get to see who's leveraged and who's not levered.
Right.
And you have to kind of, like any other bull market versus a bear market, there needs to be a period of time where people reassess, and the popularity of collecting contemporary art kind of fades, and maybe it goes to a different sector of the market.
Are you in the market for any particular piece or any artist right now?
Right now, I'm in the process of giving away some large institutional type of pieces. At one point, I wanted to have my own museum, and it's just something that I didn't really get around to. So instead of the art sitting in storage for the next 25 years, I figured it'd be better to get shown. So, for example, there's a Thomas Hirshhorn piece that just was put on display in Mocha in Los Angeles, which hadn't been seen since 2005. So, that was really kind of exciting to see that for the first time in 11 years.
All right, Adam Sender, S&P founder and CEO, thank you very much. Fascinating conversation. Really appreciate you coming.
My pleasure.
Coming up, what you need to know to gear up for next week. This is Bloomberg.
Don't miss this, our election special on Tuesday night, 7 p.m. Eastern Time with Bloomberg TV's David Gura and Bloomberg News Washington Bureau Chief Megan Murphy. This is Bloomberg.
I could tell right away.
I'm Mark Halpern.
And I'm John Heilman. And with all due respect to all you people out there who say that this election can't end soon enough, are you not entertained? That was a gladiator joke. On our TGIF menu tonight, some juicy FBI updates, a George Lopez deep dish, and a buffet of other news. But first, a hand-picked free-range cut of the sights and sounds of this busy day on the campaign trail.
Hello, Fayetteville! What's up, Pittsburgh?
I am very happy to be in the home of the Steelers.
In 4 days, we're going to win the great state of New Hampshire.
4 days left. 4 days left. And the stakes, this is not hyperbole, the stakes could not be higher.
Are we going to build a stronger, fairer, better America, or are we going to fear each other and the future?
Hillary Clinton is the candidate of yesterday. We are the movement of the future.
Understand the stakes here. My name's not on the ballot. But everything we've worked for is on the ballot. Justice is on the ballot. Equality is on the ballot. Jobs are on the ballot. Health care is on the ballot. Criminal justice reform's on the ballot. Democracy is on the ballot. I need you to vote.
The snapshot of public polling out today, for the most part, was rife with good news. For yesterday was rife with good news for Republican nominee Donald Trump. But today's batch, which is what we're focused on, has a little bit more favorable news for Hillary Clinton. The daily tracking poll by ABC News and the Washington Post has Clinton up 3 points among likely voters in a two-way race. That's 49 to 46%. That is, of course, still within the survey's margin of error. But Clinton's lead is 1 point higher than it was yesterday and 2 points higher than it was the day before that. Most of the state polls today look positive for the Democratic nominee as well. Roanoke College has her up 7 points in Virginia. A Magellan poll of Colorado voters has Clinton up 6 in the Rocky Mountain state. And there's another poll from Georgia that, for the second day in a row, shows Clinton within striking distance in that perennially red state. On Donald Trump's highlight list, a third New Hampshire poll in 2 days. This one from the University of Massachusetts shows a tied race in the Granite State. That's a state Clinton considered in her column not very long ago. And Trump still leads in Iowa, this time by 3 points, a state his team has felt pretty confident about for some time. So, Mark, as we go into the weekend, this final weekend before Election Day, where does the race stand?
Fundamentals are the same. Structurally, in terms of the public data, Hillary Clinton is ahead, and she's ahead in a way where we can see many paths for her to get to 270, and very few for Donald Trump, if any, to get to 270. I will say the following things. I was at Trump Tower today doing some shooting for The Circus, our Showtime show for Sunday night. I've never seen a group of people this loose at the end of a campaign. Maybe it's an act, but they were very loose. And they say, well, we'll probably win. We think we're going to win.
Yeah.
The Clinton people all say to me, 100% we're going to win.
Yeah.
They seem a little tight.
Yeah. Well,
maybe it's because they're the front runner and their lead has gone away. But look, I'll just say one more thing. Today's data, and even the data from yesterday, mixed about each state, perhaps, still advantage Clinton. Structurally is just overwhelming still.
Let's be clear. The Trump campaign says it's going to win, regardless of what they actually believe, because what else are they going to say? Of course they're going to say they're going to win. They got to keep their candidate confident. They don't want to deflate him in any way. And who knows, you might fire somebody.
They want a bandwagon effect.
They want, and they also, you just don't undercut your candidate if you think there's any chance of winning. The Clinton campaign has suffered through a barrage of bad publicity. They're coming off the last minute, maybe the last big surprise. The Comey letter. They've had a tough time, and they've been trying to gauge how much damage that and the fallout from that has done. I think now the polls have started to stabilize in a way that they're still going to be nervous because, in the end, something we've discussed on the show before, the psychology in Brooklyn is different. They spend all their time with Democrats who are telling them every day, if you lose to Donald Trump, and the Trump campaign doesn't have that same psychology. They'll always be looser.
Here's what we're back to. Michigan, Wisconsin, Colorado, whatever. It's the path to exactly 270 that we talked about that is most likely for Trump. If he can win Ohio, where he's ahead, and Iowa, where he's ahead, Then he's got to win the other big three. Florida, North Carolina, tough. North Carolina, very tough. He's got to win Nevada. Then he still has to win New Hampshire. But now New Hampshire and Maine, one electoral vote in Maine, those are plausible now. They're plausible.
Yes, but look, I mean, again, just to go to the Clinton campaign, they did a conference call today where they talked about early vote. And they look at the early vote numbers in Florida, and they look at the early vote numbers in North Carolina, and they say, we're on track to win those states. And if they win either one of them, no Trump presidency.
Unless he somehow wins Michigan.
No Trump presidency.
But I agree. That's why I say the Big Five is the Big Five for a reason.
Yep.
All right. Excuse me. That is the current state of the race. Now let's take a look at the endgame. There are just 4 news cycles left until America picks its next president. Between now and then, Hillary Clinton and Donald Trump are going to crisscross America, landing in as many states as they can. There are probably going to be a few states added to this list before the final events, but here is what we know so far about their schedules. Tomorrow, Saturday, Clinton and Trump are going to be in Florida. Trump also goes to North Carolina, Nevada, and Colorado.
Nevada!
On Sunday,
come on,
Clinton's in New Hampshire and Ohio. Trump makes Midwestern stops in Iowa and Wisconsin. And on Monday,